Dan, good afternoon.
Good afternoon, Jeff.
Welcome to the Medium Podcast. You're sounding much clearer now. How's the week been treating you?
It's been good. It's been busy juggling work and family. I've got a young family, so working in financial markets, there's never-ending things to worry about. I often joke that I'm a firefighter. I'm putting out fires at work. I'm putting out fires at home.
So don't you have, if you're a firefighter, right, doesn't mean you have teammates to help you out, or?
Yes, I do. I don't carry the load all my own. I have a wife that is very capable, and she's a teacher, and here in the office I've got a team around me to help me. So definitely a team.
So I just want to say thank you for coming onto the show. I think we've known each other for about 10 years now. I know we met back at Thomson Reuters, now called Refinitiv, probably back at about 2011, 2012. You've now gone on the route of getting back into the markets as Chief Investment Officer for Financial Decisions, a boutique wealth advisory / financial planning firm. Correct me if I'm wrong?
Correct.
And obviously the key part of your job is to direct the investment committee in terms of how best to manage your clients' money.
That's right. So we've got 9 investment advisors. As you said, I run the investment team and direct the investment committee. And really my primary role is to help our clients grow their wealth, generate income with a long-term investment horizon, which is at odds with a lot of people out there looking at the day-to-day noise within financial markets.
Got it. So getting back to your analogy about the whole sort of being a firefighter, putting out fires both at home and at work. Now, given the current economic situation where we're in, is there an easy fix in terms of someone sort of getting in a hose and just putting all the fires out? Or is that putting it way too simplistic?
Yeah, I mean, it's an interesting question. It's a good question. I think the short answer is not really. I think this one just has to play itself out over time. If we think about what led us to this point, taking a step back and looking at the big picture, we've had 30 years of declining bond yields. Every time there's a recession, central bankers rush in as the firefighters to put out the fire by lowering interest rates lower than where they were previously. The most recent crisis that we've all dealt with is the COVID-19 downturn. Central banks threw everything at that crisis. They dropped interest rates to zero and below zero in some cases in Europe. They poured huge amounts of liquidity into financial markets, and governments around the world also did their part in terms of the very unique nature of the downturn by providing stimulus to households and to businesses so that people could stay employed, households could be supported through what was a very difficult downturn. And now we're coming through the other side of that now. So meaning central banks are now trying to fight the other fire of the day, which is inflation, which is partly of their own making through the liquidity and the easy monetary policy settings that were in place. So effectively now they're saying to themselves, they need to back themselves out of the corner that they've put themselves in, being zero interest rates, so that they have room to put out the inflation pressures through higher interest rates, and ultimately pretty much every economic slowdown is a result of interest rates rising too far. So I think ultimately that's how this is going to end again. It's going to end with central banks lifting interest rates to a point where financial conditions tighten so much that consumers pull back on their consumption. And that's a key part of the global economy is consumption. So once that happens, the economy slows and the cycle repeats itself, and central bankers will then be cutting interest rates again. Unfortunately, this time they won't have very far to cut those rates.
I'm always curious to understand at the height of COVID, do you think there was an alternate way the central bank could have acted instead of loose monetary policy to try to, reinvigorate demand given COVID shocks? Do you think was there an alternative to that? Or do you think they
Um,
actually did their best given the situation? That was always been
yeah,
on my mind.
yeah. I mean, central banks have a blunt tool. They they have a hammer, and they see every problem as a nail.
Mm,
So that's part of the problem. To be fair, they do have other tools than just interest rates. They also have levers now being their balance sheets, so they can actually go out into financial markets and buy assets. In the most recent crisis, they were buying government bonds and they were buying investment grade corporate bonds as well. And so that supported financial markets to the extent that there wasn't going to be a financial crisis like the one we had in 2008, where liquidity dried up. Banks weren't in a position of confidence to lend to each other.
mm,
And then that financial crisis then feeds into the real economy and creates that real economic downturn. So confidence is so important. So I think central banks did their part to restore confidence to financial markets, which was part of the solution, and the other part of the solution was what governments did in supporting businesses, supporting consumers. So I don't really think central banks had much choice. I think they did what they needed to do. The only critique that I have of central banks really is they probably left conditions too easy for too long. They probably waited too long to actually normalise and raise interest rates.
because there's been a lot of debate recently about how the Fed, so to speak, was basically too late to the game. But of course, they were trying to balance the whole sort of inflation debate as to whether it was sort of transitory versus permanent. Now, I believe initially it was transitory, but I think inflation is now very much entrenched. So, getting back to the core challenge facing the economy, are you saying it's basically central bankers putting the brakes on too quickly, which would therefore cause a recession?
Yeah, I mean, I think central banks walk a very fine line, particularly at this point in time, in the sense that they're at very low interest rate settings, close to zero. They then have to raise interest rates to a point where they then give themselves enough room to lower interest rates during the next recession. So there is a fine line between raising interest rates to where they need to ultimately get to, but not tapping the brakes too hard, as you suggest, to actually to slow the economy too rapidly. And that's a fine line. If they do it too slowly, inflation expectations can get out of control, which would then necessitate ever higher interest rates, which would then further exacerbate the downturn. So it really is a fine line between raising interest rates enough to try and combat the inflation without driving the economy into a recession in a rapid fashion.
Does that have to do with the whole sort of natural rate of interest where it's neither expansionary or contractionary?
Pretty much, that sort of idea is theoretical and not easily quantified.
I was about to say that.
So, yeah, it's more academic than practical. So, from our point of view, we're not really trying to predict where that natural rate should be. We're really just trying to think about what investments can we make that we feel confident in over a 5 and a 10-year time horizon.
But if we're seemingly approaching a period where we have high interest rates and we have high inflation, that's pretty much symbolizes we're in a stagflationary environment. So given that potentially we could move into a stagflationary environment, where does one see returns in 3 to 5 years?
Yeah, so I think if your view is that we are in a sustained period of higher inflation and low growth, which is the definition of stagflation, then I think what you want to be investing in is very different from if your view is that inflation is relatively transitory, and maybe that's measured in 1 to 2 years, and growth will slow, but it won't be a hard contraction in the economy. To answer your question, if we are in that former scenario, that first scenario of stagflation, basically what you want to be investing in is assets that are benefiting from that inflation. So that could be commodities related. It could be in the form of investments that generate cash flows that are linked to inflation. So that could be thinking about real estate. A lot of real estate investments have rental escalations that are linked to inflation. So that's helpful. And in a low growth environment, in a high inflation environment, those dividend yields or those income yields from property should be sought after by investors. The other thing that we talk about a lot is we're trying to make investments that are all weather. That is, they can perform well, whether it's in a stagflation environment, whether it's in a low growth, low inflation environment, or whether it's in a high growth, low inflation environment, which is what we've had for the last 10 years. And those types of companies are companies that have pricing power, that can lift prices if there is inflation, that are capital light, they don't require a lot of physical capital to grow, and so on. So a lot of the big technology companies we refer to as having those sort of characteristics, where they can raise prices, whereby they're creating these markets, whether it's in cloud computing or within software as a service. Those markets are actually growing rapidly, and they're creating these new markets that businesses and consumers are adopting because it lowers their cost of doing business. It's a cheaper form of entertainment for them, etc. So, we do think a lot about macro, but at the end of the day, it doesn't overrule our sort of bottom-up fundamental investing philosophy.
Got it. So if we have a company that is able to pass on higher prices to the consumer, which therefore protects their margins, but how would that work if it was in an environment when there's low economic growth, rates are high, therefore people are sort of curtailing their discretionary spending? So isn't there a bit of a balance between raising prices but not raising it too much, which therefore stifles demand?
Yeah, exactly. I think the other thing you've got to think about is from a consumer's perspective, of which we're all consumers by definition. If we think about streaming services as a form of entertainment, if we have 3 or 4 streaming services and we go through an economic downturn and we're looking to reduce our costs, well, maybe we'll reduce one of those streaming services. We won't have 3 or 4, we might have 1 or 2. So you're right, there is risk in that particular category of consumers saying, you know what, we're gonna switch off, or we're gonna trade down. So there's definitely risk in certain categories like that. But I would also sort of juxtapose that with the fact that it's pretty good value to have these streaming services. You might be paying $15 a month for a huge content library, as opposed to, let's say, if you go out to a movie, you're paying $15 a ticket or $20 a ticket for an hour or 2 hours of entertainment. So I think you're more likely in a downturn to see people, and this has historically happened as well, People actually substitute expensive forms of entertainment for low-cost forms of entertainment, which streaming is a low-cost form of streaming entertainment.
Good point. Good point.
Another example might be, I guess, before the current environment that we're in now, our view was that consumers would be substituting goods purchases, which they made during COVID, because they were locked down and they were at home and they were going to Bunnings, they were upgrading their homes, they were upgrading their appliances, and so on, for services. The economy opens up, you can travel, you can go to coffee shops, restaurants. So you then reduce your goods consumption and you increase your services consumption. In the world that we now find ourselves in, where, yes, things are easier to do, you can go to restaurants, you can travel, but you know what, maybe given the slowdown, given the fact that interest rates are going to start rising in the next couple of years, maybe we won't go on that big overseas holiday, maybe we'll just travel domestically. And so that's, again, another form of substitution that households can make to manage that low growth, slow economic growth environment.
Interesting. So in a way, you could sort of say that consumers will still spend, but instead of going on that very expensive holiday overseas, they substitute with something locally. So if you're a sector or an industry that caters to local tourism, for example, that could be part of the portfolio which can weather all seasons. And that's very much a bottoms up approach to investing, because you're pretty much thinking long term, aren't you?
Yeah, we're thinking 5 to 10 years. In a lot of the sectors in financial markets, it's hard to invest in companies that you can have confidence in for a 5 or 10 year period. It tends to be a pretty short list of companies. So, you know, the themes that we've touched on in terms of travel, you know, we haven't really got investments focusing on that sector because a lot of the companies there just don't meet our minimum quality criteria in terms of sustainable competitive advantage that can do well in both a boom and a bust type of economic environment. There are some examples domestically of travel-related companies like Webjet, for example, where it's a platform business that is actually a pretty reasonable business. It's a little bit small for us. We tend not to invest in companies of that size, but it's probably one business that we could invest in theory, but we don't, just based on the fact that we can fish in a global share market where the opportunity set is so large and so high quality that we tend to invest in technology platforms in overseas markets.
But if a company like Webjet, for example, or something locally who's smaller, who might go under your remit, wouldn't that still be quite an attractive proposition if the fundamentals stacked up?
It would. We tend to outsource our smaller cap investment to fund managers, and we'll prioritise our direct investment research in the larger set that is there, like the one I described, in terms of offshore direct investments. But certainly we'll use local fund managers that have the capability and capacity to go and dig through the weeds and look at, you know, hundreds of companies in any given year and make those allocation decisions. So there's certainly those managers out there that we try and leverage.
Got it. But for yourself and your team, you're very much focused on those quality overseas technologies companies. Is that correct?
Yeah, we really focus on a few sectors. Technology is one of them. Healthcare is another. Consumer to a lesser extent, because it does still tend to be quite cyclical. Industrials is a little bit cyclical as well, but there are companies in the industrial space that are actually set to benefit from some pretty strong long-term trends, being de-globalisation, which was something that really started under President Trump, where he was sort of bringing manufacturing closer to the US or within the US, away from China. So that was a thing that was started really gaining traction under Trump. But then it gained even more traction as we went through COVID-19, where it was pretty obvious that supply chains were not very resilient. There wasn't a lot of redundancy in supply chains, which meant that over the course of the next few years and probably the next decade, countries and companies all around the world are going to have to add redundancy. They're going to have to invest in more capacity so that there is that buffer that was not in place prior to COVID. We've gone from a just-in-time system to a just-in-case system. So there are a lot of companies, or there are a few companies that we've invested in that are expected to benefit from both that increased capacity in supply chains. And the other point, which I haven't touched on, is automation. Companies are looking to become more efficient, deliver product to their customers in a lower cost and more efficient manner to protect their margins. And that's becoming even more important now with inflation.
But that ability to invest in, expanding the coverage of supply chains, that's very much for the big boys, isn't it? Like, it's very hard for the smaller guy to sort of compete. Because I know recently Apple decided to perhaps create new supplies in Southeast Asia. Now, I can understand how an Apple could do that, but for the everyday mid-tier organization, expanding their supply chains and bringing it locally, for example, that's going to be quite a substantial investment.
Yeah, no, it definitely is. And it's something that I hope we see more support from in terms of government support. We have seen signs of that from both sides of politics here in Australia. So I think that has to continue. Our manufacturing sector here in Australia is pretty much non-existent these days as compared to when 20 or 30 years ago, when we had an auto sector, and now we don't. And there are a lot of other industries like that have now gone. But I think the types of products that will be manufacturing will need to be higher end products. In general, I think there will be exceptions. For example, in commodities, we produce the world's best iron ore. We produce some of the best lithium in the world, which goes into batteries, which obviously are in huge demand, and the demand for lithium is expected to increase by a factor of 10 over the next decade. And we have some of the world's best lithium mines in WA. But back on the point about manufacturing, companies over in WA are looking to not only dig up lithium out of the ground and send it offshore to be converted into chemical product, which then is further refined into batteries. But so what we're doing here in Australia is looking to increase the value add from just mining the stuff to actually creating chemical. So that's taking one step up the value chain. And I think we're going to need to do more and more of that going forward. And I noted that Labor have a $200 million battery manufacturing grant in their budget, and a $100 million battery incentive, which is more broadly than just WA. So I hope to see more of those types of initiatives.
So it's very much vertical integration, but keeping it in your backyard, essentially.
Yeah, exactly. So rather than giving the margin to companies in Korea or China, we'll be keeping the margin here in Australia, and that will require investment upfront, but the payoff will come.
They'll also require changes perhaps in immigration law to bring in skilled labor, because it's very much immigration, education in terms of the next generation. So it's not an easy decision to make, isn't it? Hence, you're saying this could take at least 5-10 years to see this whole new deglobalisation theme roll out. Hey,
Yeah, exactly. And I mean, the deglobalisation is one part of it. This sort of sustainability revolution is another. Regardless of your views on climate change, the investment that's going into those sectors is real, and the opportunity is real. So, you know, the having the will is one thing, having the funding is another, having the expertise and capabilities and labour pool is another. And I think training is a big piece of the puzzle. Training and upskilling and retraining the workforce. I think that's going to be a much bigger part of everyday life going forward, as opposed to once upon a time you go to university, you get your degree, and that's it. Now I think people are changing jobs, potentially changing careers, 5 or 6 times throughout their working life, and that requires retraining. So that's a big piece of the puzzle as well. And you touched on immigration, which we haven't had for the last 2 years, and that's going to be a big driver to support those initiatives.
and what's interesting is that here we are, we're talking about the economy, yet our conversation is so broad. And like what you said originally, there's so much stuff going on right now, and it's constantly changing. Now, we haven't even talked about political unrest, so to speak, and the whole war that's affected supply chains. So there's a lot of people that say that, history repeats itself. But do you see today that the current scenario is very unique?
It's not unique in the sense that we've had supply chain disruptions in the past, specifically centered around energy, around oil. We've had wars fought over oil in the past, and whether or not this war was about oil or not, it resulted in shocks to energy, to fuel, to food prices, agriculture. The Ukraine is really a pretty big breadbasket when it comes to producing wheat and other agriculture crops, as well as a host of hard commodities like nickel, which also happens to be a big input into batteries, which we produce quite a bit of nickel here in Australia, and copper, aluminium. So yeah, I mean the war really has thrown a spanner in the economic system and the supply chain, which was already straining before it happened. So I think if we didn't have that, there wouldn't be as much concern over inflation and around rising rates. I think it would definitely be more orderly. So yeah.
Also, what's interesting is that I also read recently where India and Asians in Southeast Asia, they're dealing with massive heat waves. So then themselves are going through the process of basically going, you know what, since we can't really feed our own populations, we are basically going to keep the grains to ourselves, which that also therefore affects the global food supply, which therefore could raise prices. So it seems like a perfect storm in terms of everything just really coming together. Getting back to your clients, Dan, what do you tell your clients about this? Because this seems quite a challenging undertaking for an average person to really get around.
Yeah, I mean, from an investment perspective, which is really where I focus my attention day to day, it's about trying to find companies that can control their prices, that have economies of scale, that can generate profit growth and reasonable dividend yields, irrespective of the climate that we're seeing. That's really the job. there are all sorts of issues related to the war, related to supply chains, related to slowing economic growth, and really at the end of the day, what we can control is what I've just been talking about. So that's really where we focus our attention. So there's a lot of bad stuff out there, and a lot of it is out of our control. We could wake up tomorrow and Putin, something could have happened to him, and it's a different ballgame.
Yeah,
potentially,
constantly keeps changing, doesn't it?
So geopolitics is something that is, the backdrop to what we're doing, and it definitely influences asset prices in the short term.
Long term, less so.
In the long term, what's most important is the ability for companies to generate earnings growth. And so we need to really look at the fundamentals of these companies, the markets they're operating in, the pricing power they command, and whether or not they're offering value to their clients, which could be households or it could be other businesses. So really that's the focus. So everything else is interesting, but ultimately very hard to predict. So we don't spend, as I said, a huge amount of time worrying about that stuff.
Got it. And getting back to companies, I remember Warren Buffett used to say, you're not buying a stock, you're buying a company. So if you can find a company that can compound its revenues time and time again, has a strong defensible moat, that's essentially what you want. So I'm curious, is there one company that really comes to your mind that really fits the bill in terms of a company that can really grow its earnings over time? Now, keep in mind, I do know that this is not financial advice, but I'm very curious to see your thinking in terms of what that company would be.
Yeah, there are a few companies that come to mind. One of the most obvious for me at the moment is probably Microsoft. Microsoft is a company that has reinvented itself a few times over in the last couple of decades. It started off as a company that was selling software in the form of operating systems sitting on personal computers back in the 90s. That was really their key business, as well as a little bit on the server side. So that was really the business. It had a virtual monopoly over that market, didn't have a lot of competition, and so it could control prices. It was putting out software regularly in terms of updates, which either would then go out and purchase. So that was sort of the starting point for Microsoft. Jumping ahead, the last sort of decade or so, they've latched on to a different form of business model in terms of the subscription model, whereby rather than buying the software outright and then in a few years' time upgrading and buying a new piece of software, you're basically paying a smaller fee each and every year. Microsoft will then keep giving you updates over time, giving you more services as part of that subscription, which then creates a stronger, let's call it ecosystem for you to then try and leave would be really difficult. And so that's a big part of their business. It's not all they do. They now have a cloud computing business as well, which I think a lot of people are relatively familiar with, some less so. But basically the idea behind cloud computing is that primarily businesses, rather than hosting software applications in servers that are located physically within their offices and place of business, rather than having that and having an internal IT team manage that server, all those servers and that software, basically Microsoft is providing an all-in service so that if you want to scale up the number of applications you're running, you can do that easily and cost effectively. You don't have to run your own IT team. Microsoft do that for you. And what what not only Microsoft is seeing, but also Amazon, which is actually the biggest player in cloud computing, and Alphabet or Google is seeing in cloud, is these are three of the largest companies on the planet. And within these cloud businesses, they're growing at anywhere from 30 to 50% year on year.
Crazy, eh? Huge, eh?
So they're in their view, and we share their view. Cloud computing has a long runway of growth ahead of it, simply because it's a way for businesses to manage their costs, manage their budgets, to reduce their capital investment. So Microsoft take care of all of that, and it just creates an IT solution that's more scalable and more cost effective for them, so that they can run their business more efficiently. And I think every business out there is looking for ways to do that. So rather than cut back on the services that Microsoft offer, businesses are actually looking to lean in and add to that. So those are the two core businesses for Microsoft, which have one or not many competitors, and they have pricing power as a result. And from their customers' point of view, the value that they're offering their customers far outweighs the cost to those customers, and that's why we think it's a great business model, because customers won't switch it off because there's no alternative. A, and B,
it's way too sticky.
Makes sense. The return on investment for the customers is very, very good.
Interesting. So we've got the cloud business. I believe Microsoft Azure is only second to AWS. Number two, we've got Microsoft's software business, which is recurring revenue for it. We've got that massive tailwind in terms of organizations moving to the cloud. Correct if I'm wrong, moving a capital expense in terms of IT hardware, moving it and turning it into an operating expense, which therefore provides a bit more predictability. So wow, yes, I agree, Mike. And I think from a consumer side of things, I don't think that's really much their focus nowadays. Correct if I'm wrong. It seems like to me they're very much playing in that large enterprise space where they have that pricing power. Correct if I'm wrong.
Yeah, that's right. It's definitely more of a business to business proposition these days. Not to diminish the businesses where they do face consumers. So Xbox would be one of those, so video gaming. And in fact, Microsoft are leaning into on that side as well, which I haven't talked about, but they're acquiring Activision Blizzard, which is one of the world's biggest producers of video game content. They've been around a long time. They have a lot of different franchises across different platforms. So mobile, people may be familiar with Candy Crush. So Candy Crush is one of their titles. So that's soon to be.
Oh, they bought out King, I believe. King Software, I believe.
Yeah, so Activision bought King. So Microsoft will soon own Candy Crush. They'll own Overwatch. They'll own World of Warcraft. They'll own Call of Duty, I think, is in there.
I think they got Minecraft from acquisition from before.
Yes, that's right. So I guess video game producers and content and franchises are immensely valuable in the sense that you have these hardware players and these ecosystems owned by the likes of Microsoft and Apple and others, whereby they're looking to think about how do we create a more sticky and value-adding service to our customers within the ecosystem. And one of the ways they can do that is by having, A-rated content. In this case, A-rated video game titles. So it makes a lot of sense. It's been a long time coming. In my view, it's been a relatively obvious opportunity for the likes of Microsoft, and we've owned Activision in our portfolios. So we're pretty happy that Activision shareholders will be getting a pretty good price for their shares, hopefully once it goes through.
Interesting. And I think the only thing that may potentially block that acquisition is, I believe, the US is equivalent of the ACCC, I believe.
Yeah, it's basically got to be approved by, I think it's 15 countries. So it's not just the US, it's actually got to be approved by 15 countries around the world. So Activision's trading at quite a big discount to the offer price. It's trading, I think, about in the low $70 range, which I think is about a nearly 20% discount to the bid price. So there's a chance, and markets are suggesting there's a pretty high chance that the deal doesn't go through. So, you know,
And why is that, sorry? Because of the whole monopoly threat, or do you mean the pricing disparity?
Yes, because of the competition, anti-competitive potential blocking the deal. Interestingly, Warren Buffett, his company Berkshire Hathaway, have recently added to their position in Activision. So they think, in their view, it's a pretty good buy.
And why does this need approval, sorry, from 15 different countries?
It's basically around competition. So whenever there's a big acquisition like this one, which will be the biggest acquisition that Microsoft have ever done, it's tens of billions of dollars. It's absolutely enormous. So it's really around the fact that if Microsoft get their hands on these video game titles, will they allow these titles to be accessed on non-Microsoft hardware? So, for example, can I go and play an Activision game on my Apple phone? Can I go and play an Activision game on my Sony PlayStation, which is obviously not owned by Microsoft? So that's really where it's going to come through. But Microsoft has said they're not going to change anything when it comes to distribution. So I think regardless of if they're true to that word or not, I think it's still a good deal for Microsoft, because they could add things, or they could add value to their customers, which would create those more sticky relationships.
It reminds me of Amazon Prime, how I think the membership is about $119, I believe, US per year. And you give the customer so much value that they'll be stupid not to pay $119 per year. And we sort of, yeah.
Right. So that's really what it comes down to. So if you add up all the individual services you're getting from Microsoft, it far outweighs the annual subscription.
So is it the right time to buy Microsoft? Or I know you and we had a conversation about, where technology stocks are going right now. You yourself said you focus on technology stocks. I think the NASDAQ is about down maybe 20%, I believe, year to date, roughly.
Yep.
Are we going to go lower? Or obviously you and we know that very much our conversation is very much predictions, but I am very curious to understand your thinking behind it. Do you see the market having that natural reflex of buying the dip because people see that there is now value and that the price sales multiple for a lot of companies in the industry have mean revert to sort of the 15-year average? Or do you see that with Jerome Powell thinking, maybe we can't have a soft landing, we're going to see more rates, hence the NASDAQ's going to pile down a bit?
Yeah, I think it's still a time to tread carefully. I don't think it's a time to rush in. We're seeing extreme volatility day to day in the market. One day we'll see growth stocks up 5%. 24 hours later, they'll be down 5%. So there's a real lack of conviction out there. And I don't think you need to be a hero. There's a saying, you don't want to catch a falling knife. When prices are falling rapidly and in a really volatile and loose fashion, it's not a time to be bold. It's a time to hit singles rather than trying to hit fours. So really, we're focused on protecting capital first and foremost, investing in good companies like Microsoft, where if we close our eyes and the stock market shuts for a few years, we're happy.
You're right.
Because we know that they're going to continue to grow their earnings at 15 to 20% per annum. And so to answer your question, is now a good time to buy or not? We think it's always a good time to buy, because over the long term markets do rise. And the other thing to note is that every year markets decline at some point. A very simple strategy, and this is stepping out of the weeds of markets and volatility, a very simple strategy is to simply buy the market when it's down circa 12% intra-year. Because most years the market falls 12%, and most years the market finishes higher than it started. So that's a very simple strategy, which is a bit like dollar cost averaging, where you just put a little bit of money into the market over a period of time.
Got it.
And so you're not trying to pick the bottom, you're just trying to put money to work over time.
So very much, if you have a long-term view, technically speaking, you can catch the falling knife as long as you have a long-term view of that company.
You do. You have to have a long-term view. You have to have the stomach for the volatility, because to think that you're going to buy in a volatile market and not see a loss, I think you're kidding yourself. A very simple statistic, if you look at the market on a very short-term basis, day to day, week to week, your chances of being right, as it were, that is the market going up, if you're a long investor, are not much different from 50%. But if you check the market on a yearly basis, your chances of being right, I'm going to get the number wrong, but let's say 80%. So if you want to be right, don't check it daily. If you want to be right, check it yearly.
So that means we delete the trading apps on our phones. Is that correct?
Yes. The trading apps are designed to encourage you to trade. They're designed to make you greedy and fearful and overtrade and focus on what's not important, which is the short term.
Hey, and by all means, if you're a short-term trader, fantastic. A trading app will be fantastic. But if you're very much a long-term investor, you literally want to have those investments where you can close your eyes and not think about it for, 1 or 2 years, because it's that good.
Yeah, I mean, my personal view is, if you want excitement, go to the casino. If you want excitement, I guess you can get it from the stock market too. It's very easy to do that. It's open nearly 24/5. You can trade markets all around the world.
Yeah.
You trade cryptocurrency 24/7. Who doesn't want to do that? But investing is about playing the long game, and it goes against human emotion to do that.
It does.
It takes a real strength,
discipline,
to step back, and discipline to step back from it. And I think that's a big part of the role of financial advisors, is actually to do that, to make sure clients are doing the right thing at the right time. It's not just about having the best ideas, the best insights, the best trading strategy. It's also about having that coach to help you make the right decisions at the right time. And that applies to everyone.
Now, I'm not too sure how financial advisors work, but I do recollect, Charlie Munger, like, depending on their KPIs, that could potentially go against the long-term game, could it? Or
for fund managers or for the CEOs of companies, yeah. Incentives. It's all about incentives. You show me the incentive, I'll show you the outcome, I think is what he said.
Exactly.
Or someone else said it.
No, Charlie Munger, bang on the money.
It's true. So yeah, I think about incentives a lot, not only from a work point of view, but also with my kids. And if I want to get a certain outcome from my kids, I need to think about what incentives I can give them, both good and bad, to try and coach them towards that outcome that I want. So
what's harder, raising your kids or trying to navigate the markets? But I think navigating markets for you is easier because you have a long-term view. But then again, with your kids, I'm pretty sure you also have a long-term view.
definitely have a long-term view with my kids.
Yeah.
You know, it's about embracing the here and now, because kids don't stay kids for long.
Mm-hmm.
So it's definitely a different time frame in that sense. But also at the same time thinking long term and thinking, you know, my son, my daughters, what are they going to be like in 5 or 10 years' time? How is the way I'm raising them, my wife are raising them now? How are those lessons going to help them when they're
very much an investment,
when they're going through their job, you know, whether they're, you know, looking to settle down at some point in the future. You know, you want to try and think about that a little bit in the back of your mind, and really just, it's about day by day and trying to, you know, teach them small lessons every day to drive them towards those, whatever outcomes you want to try and achieve. But, you know, you want them to be happy and successful.
And with kids, you can't take them out of your portfolio.
No, you can't sell them.
You can't sell them. So you gotta make sure that when you getting a bit of analogy with the markets and kids is that, you know, you got to, obviously you don't get to choose, obviously, but you need to work with them, and it's no different from you working with a company to really build them up.
Yeah.
So what do you think about the whole 60-40 split nowadays in terms of the so-called way to create a portfolio?
Yeah, I mean, it's probably less important what I think, and it's probably more important what the market is thinking in terms of what the big pension funds around the world are doing. If you look at the Future Fund here in Australia, their portfolio has very little exposure to bonds. Off the top of my head, I would say it's less than 15%. It may even be less than 10%.
Wow.
They have a big exposure to alternative investments, private equity, private infrastructure. They can make those investments for a few reasons that maybe retail investors can't, in the sense that they have a very long time frame. They have a pool of investors that aren't going to go away. They're not going to pull their money out, and they have they have the ability to write very large check sizes. So a lot of these private investments require those two key characteristics, being large check size and very long time horizon. So, and that helps them in regards to volatility, because private assets don't get marked to market on a daily basis like listed investments do.
Mm.
So to answer your question, is the 60-40 portfolio dead? Yeah, I think it probably is dead. We don't have 60-40 in our portfolios. We tend to have a greater weighting towards equities than fixed income. And within fixed income, we're thinking beyond just government bonds. We're looking at private credit. We're looking at asset-backed securities, securities that are backed by property. We like that have very large margins of safety. So if there was a downturn in the property market, for example, the property prices would have to fall by around 45% before our investors would be negatively impacted. So there's a big margin of safety. You've got an asset that you can see, that you can sell if you need to, and they're generating pretty good yields, certainly a lot higher than government bonds. So that's sort of how we've approached it. And the other asset classes that we're investing in are things like infrastructure, mainly listed infrastructure. So we're investing in fund managers and directly ourselves in airports, toll roads, gas pipelines, as a few examples there.
And those industries are very much all-weather because they're non-discretionary, so to speak. You're always going to need them. So what are your thoughts on cryptocurrencies? Is there room for cryptocurrencies?
There probably is, for people that are more knowledgeable about that space than I am. I don't pronounce myself to be a cryptocurrency expert. My general sense is that the blockchain, which underpins cryptocurrency, has real utility and real value. And so I think the cryptocurrencies, if you want to call them that provide utility to companies that are building applications on the internet that sit on top of that sort of blockchain ledger system, have a place. Because that's a utility, that's real value to those applications and those companies that are leveraging that decentralized ledger. So yeah, it's real. What's the value? Don't know. It's hard to quantify. Bitcoin isn't one of those cryptocurrencies. It doesn't provide utility in the sense that it's not a piece of infrastructure that you can build an application on top of, but decentralization. It's pretty much a pure speculative asset. Has no utility. People like it. It's gold. It's a digital version of gold. So I get that. I get that concept. But personally, a bit like with gold, I'd prefer to own something that has utility. I'd prefer to own a mining company that digs up copper, that then goes into electrical appliances, electric cars, etc. It has
there's some sort of utility, like you said, and there's a lot of people out there where some might see it as a Ponzi, some might see it as a joke, but at the end of the day, it's really each to their own in terms of where do they see the value, isn't it? So I'm very curious, Daniel, in terms of there is financial decisions, looking at disciplined returns, a long-term view, very much about preserving capital and growing it in a sustained way. If I remove your CIO hat, does that approach reflect you on the personal front?
Absolutely. I started working a few years before the GFC. So I was starting, when I was still at university, I started working in the industry as a fund manager. And it was a booming time. The year was 2003, 2004. It was in the midst of a mining boom. China was absorbing as many of our iron ore tons and copper output and other things as quickly as it could. And so there was a massive boom in the markets. When I came out of uni, I worked at Citigroup on the global trading desk there, which was an experience. And that was before the GFC. That was in 2007. And I went and started work after that, 2008, the year of the GFC, for a small cap Aussie equity fund manager. So we were investing in companies that, in a lot of cases, had great ideas. They were going to execute. They were going to change the world. Didn't have the greatest balance sheets. Didn't have a lot of cash flow, but had great ideas. And so I think that episode really taught me that great ideas might sound good, but the harsh reality is you need to be well funded, you need to have a strong balance sheet, and you need to have more than just an idea. You need to have runs on the board to demonstrate your value to whoever it is you're trying to sell your services or goods to. And so those lessons I've carried with me I think it's a bit like people that came of age during the Great Depression. They're scarred by that experience, and so you tend to have more loss aversion than otherwise would be the case. So I definitely have a very strong bias towards loss aversion, which has actually hurt my own investment outcomes over the last decade plus,
because you're so risk averse in a way, or?
Yeah, I've always had too much cash, and so the markets tend to rise over time. As I said, they tend to have these periods where they fall, but over time they tend to rise. And if you're buying companies that are paying you dividends, you're getting that income stream along the way. And if you're sitting in cash earning zero, then that's a massive drag on your overall performance. So I think my biggest weakness personally is loss aversion.
Are you working on that personally?
Yes, I guess I am, in the sense that I'm trying to make sure that the investments that I do make, I'm happy if the share market was to be switched off. So I have companies in my portfolio like Microsoft, like Alphabet, like Johnson & Johnson, big companies, diversified, global businesses with strong pricing power, that if the share market wouldn't make, these companies were going to continue to grow their earnings. And so that's the best way I've found to actually get away from that loss aversion bias that I've got and try and avoid companies that are speculative.
You're not the type of person to, getting back to your cricket analogy in terms of getting singles, you're not the type of person who's going to hit the sixes.
I limit how much of my portfolio is exposed to those sixes. So I come across a lot of really interesting companies. Let's call them story stocks that may not have cash flow or earnings, but I really like the story and I believe in what they're doing. And so, if you have a small allocation to something like that, knowing that you could lose everything, that's okay. It's all about sizing. And if you put 0.5% of your portfolio in something that could go up 20 times, and the downside is 100%, that's probably not a bad bet. But when I'm dealing with client portfolios, those are not the types of bets that I'm making. But I'm happy to do them on my own, because if I lose the capital, I can justify it and it's no problem.
Do you sometimes have clients that want you to go for a six?
Yes.
But then you've got to go back to them and go, that's not our approach.
Yeah. So we have a lot of wholesale clients that have a bit more of a penchant to take a bit more risk. And so for them, it's really a case of saying what I just said, really, which is you have your core portfolio, which adheres to our philosophy and our principles. And if you want to allocate 5% to investing in high-risk speculative investments, go for it. But you allocate that budget to those investments, knowing full well that you could lose that 5%. And if you lose that 5%, is that going to negatively impact your ability or your lifestyle? Let's say, if that's the goal here for the capital to fund the lifestyle. And if the answer is, if I lose that 5%, it makes no difference to my lifestyle, and go for it. But it's really about setting the expectations and making sure clients understand the purpose, the risks involved.
I suppose for me, I always question, where is the best way to put your money and your time that's going to generate the most return? Now, if I put that question for you, where do you think that is? Now, I don't want you to limit yourself to financial products. Let's have a bit of a spin here, right? What do you think is the greatest investment? Don't confine yourself to financial markets. You could probably know where I'm leaning towards. Maybe you do, maybe you don't. What do you think that is?
The greatest investment that you can make is education. The return on investment, I haven't actually done the numbers, but it would be astronomical. I think I studied, I did engineering and finance, two quite unrelated disciplines.
And you did very well. I believe you had an honours in engineering as well, I believe.
I did. I even won the Microsoft Asia Pacific Prize for my software engineering thesis.
Wow.
Which I did for a fund manager. So I wrote an application for a fund manager, which then later became a product, which I actually saw the other day, and I hadn't seen it in 10 years. I didn't even know it had been turned into a product. So there you go.
Telling me that you still got royalties, right? Or
no, I did it for free. but I got a high distinction for that. So I was pretty happy at the time. But no, I mean, education is hands down no-brainer, best investment you can make. From a parent's perspective, that obviously applies. Helping your kids learn and be curious and love learning. I think that's the most important lesson, or one of the most important lessons that I try and teach my kids, along with being compassionate, and caring, and kind, and generous, and having a strong set of core principles to live by. But yeah, education, and for kids, it's about spending time with kids. I think that's so valuable. So whenever I'm tempted when I'm with my kids, as we all are, you've got your phone next to you. It's very easy to just be distracted. And one of the things I work on myself is try not to be distracted, to be in the moment, because those moments don't last very long.
So I was going to say, does your job occupy the most of your thoughts? And I can answer for you, does it? Your family is very much a pivotal part of your life, isn't it, Dan?
Absolutely. It's front and center, a core part of my life, the core part of my life. I'm very lucky. The company that I work for, Financial Decisions, is a big family. I've been here just under 12 months. But the culture of the firm is really a big family. It's a family office working for family offices, our clients. So I get a real kick out of trying to help our clients achieve their goals, and really speak to them one-on-one, just as person to person, as opposed to being this big picture macro thinker or analyst, portfolio manager, which is a really fun intellectual exercise. But at the end of the day, you've got to think about the outcomes you're trying to achieve, and that's obviously helping people fund their retirement, fund their lifestyle. And when I'm out talking to clients with the advisors, more than half the conversation is not about investments. It's about their families. It's about their kids. It's about what they're doing. It's about what their goals are, where they're going on holidays, what they're doing with their property.
It's very much our conversation. We started off very much on a technical basis. We talked about macroeconomics, geopolitics. We got pretty deep. But what's interesting is that throughout our conversation, the kids always come up.
They do.
It's beautiful. It's beautiful, isn't it?
But at the end of the day, when you do, we're taking the big picture view, the long-term view, when we're trying to build portfolios and make investment decisions. And with kids, kids are a big part of both my personal life, but also our clients, right? Our clients are thinking, what legacy do they want to leave to their kids? How do they want to help their kids, their grandkids? Whether it's setting up trusts to help them fund their education, school expenses, university, helping them buy their first home. Children are really where a lot of the focus for our clients is. It's where a lot of my focus is for my kids.
It's beautiful. It's beautiful.
So,
I love it how you've intertwined your kids into this conversation.
well, they're waiting for me at home. So I'll.
Here's a question for you. Let's park everything aside. This has been a great conversation. Let's park it all aside. Let's take off your CIO hat. Let's take off your dad hat. Let's take off your husband hat. Now, personally for you, what legacy do you want to leave behind that would make you proud of yourself when it finally comes for you to leave this world?
That is a huge question. Huge question.
I did say to you that I was going to give you some hairy question, right?
You didn't disappoint. Look, it's a very good question. I think on a personal note, because I think most people will be forgotten within a couple of generations. I think that's just the reality of the world we live in.
Unless you get on the wiki page.
Right. Unless you do something, unless you take some risk. I think unless you take a little bit of risk in life, you're probably not going to leave a real big lasting impact on the world. My goal is not necessarily to leave a big lasting impact on the world. I think my focus is really around personally my kids, my grandkids, so that they can say he was a good bloke, you know, he taught me some lessons that I can carry with me and I can share and take to the next generation. I think, you know, we're all part of a chain, and passing down those lessons is a big focus for me now. And obviously from a work point of view, helping clients to do that with their children and their grandchildren it is a focus day to day.
Beautiful answer. Now, before we sign off, your kids are going to be watching this in, what do you reckon, 10 years time? A bit longer? Okay,
Possibly.
Here's a question for you. When do you think they'll watch this so they would understand what we're talking about? Give me an age.
Mid-high school, maybe.
Mid-high school, 16?
15,
15, 16 years old? Okay.
Yeah.
Now, as a final thought, you know, we've talked quite a bit about the economy, stocks, shares, portfolio split, approaches with your clients, how we deal with risk. What is some final words that you want to leave your kids when they watch this, when they're 16 years old? And that's probably about 10 years time, is that correct?
Yeah, more or less.
Yeah.
Yep.
What's that
Well,
final remark that you want to leave for your kids?
Be kind, be curious, never stop learning, never stop trying. That's it.
Well said, Dad. Thank you very much for your time.
Thank you, Jeff. It's been fun.